Hey y'all, so for today's Wednesday lesson, what you're going to be doing is watching this short video and then answering a question afterward. So don't forget to submit the question at the end, just kind of a reflection on what you've learned. So we did a survey at the beginning of the year where I asked something that you'd like to learn about this year, and quite a few people said taxes, which I thought was pretty surprising. And we have these sort of one-off Wednesday lessons that are self-guided, so I thought today we could learn the basics about taxes, especially given what's been in the news. Cool. So taxes are an inevitable part of your life that you're going to have to be dealing with at some point. Many of you probably already working and have already experienced this process. So in general, taxes are required payments, either to local, state, or national governments. Taxes are used to pay for the services that a government provides, like schools, police, roads, bridges, other infrastructure, like dams, things like that sometimes are government funded. Defense, the army, things like that. So why should we care? Well, everyone has to pay taxes. That's pretty important. A lot of political issues are driven by tax issues, right? How are we going to pay for this new policy and so forth? Communities are funded by taxes, so a lot of the nice things that we have in our community, like the buses and the Macs, for example, are funded by local taxes. And the more you know how to handle your own taxes and can save you some money. Cool. So constitutionally, taxes are legal in the United States. Article 1, Section 8, Clause 1 of the Constitution grants Congress the power to tax. Later on, the 16th Amendment gave Congress the power to levy an income tax. We'll talk about what that is in a minute. So this graph is a little outdated. It's from 2011, but not a ton has changed. But this is basically how taxes are spent on the federal level. So you can see this section over here is called mandatory spending. So that's kind of stuff that's already set in place. Tax revenue comes in, and this money has to be spent on those things. Over on the right here, we see discretionary spending. So discretionary spending is up to the current administration. They have about this much, 30% or so, of the budget to decide what to spend it on. And then some of that goes to interest. Cool, so there are some limits on how governments can tax. The purpose of the tax must be for the common defense and general welfare, according to the Constitution, which is a little bit vague, but generally the taxes have to serve the people. Federal taxes must be the same in every state, so you pay a federal income tax everywhere, no matter where you live, but then states can decide other things, like some states do not have an income tax. For example, our neighbor to the north, Washington, there is no income tax. The government can also not tax exports, so if you make a product in America and you want to ship it to some other country, the government can't tax that. At least our government can't do that. Sweet. So I want to talk about three forms of taxes, so three different types of tax, and kind of what the difference is and arguments for and against them. So there's something called a progressive tax, and we'll spend most of our time talking about that because that's what the income tax looks like. So we'll get deep into that at the end. There are also regressive taxes, and there are proportional taxes. So let's talk about what each one of those is. A regressive tax, by definition, is a tax which takes a higher percentage of income from the poor than from the rich. The biggest example of this is a sales tax. Now, we don't have sales tax here in Oregon, but in most states, when you buy something at the store, you pay taxes on it. Right, for example, if you go and buy $100 worth of groceries, you might have $10 more to pay in taxes. So the argument for this is that taxes are only levied on what is bought. So for those who spend lavishly, they end up paying more in taxes. The argument against is that the tax harms those who can least afford it, right? If a very wealthy person buys $100 worth of groceries, it's not a big deal that there's an extra $10 tacked on for taxes. But if that $100 is a huge part of that person's income, then that $10 can really make a dent. So this is why it's called a regressive tax, because it is a little more punitive, I guess you'd say, to people who are a little bit more poor. And that's why some states have decided to get rid of sales tax, at least on some items. like here in Oregon. There are some sales taxes here in Oregon. We'll talk about those in a minute. Cool. So for example, let's say two people buy a car. So it's a $20,000 car. So let's say they both pay $1,600 in sales tax. Okay, about 8%. Yeah. All right. So let's say the first person makes $30,000 a year. That's their salary. Then that sales tax is a huge chunk of their income, right? At 5.3%. Yeah, that checks out. Cool. Let's say the second person makes $100,000 a year, so they have a much higher salary. That sales tax is a much smaller part of their income, so they're affected less. Cool. So kind of a simple example, but that's the idea. So this is what most sales taxes are, what we commonly think of when we think of tax. There's also something called a proportional tax, and this is not something that we use in the US, but there are some countries that choose to use a proportional, also called a flat tax. So this is a tax that just as a blanket policy charges everyone the same percentage of income no matter what you make. So everyone pays the same percent. Say everyone pays 15% in taxes, right? Regardless of how much you make. The argument for this is that it's very equal, right? Everyone pays the same percentage. The argument against is that the poor need their income more than the wealthy. So people who don't make a ton of money, they spend every penny to survive and buy the things they need, whereas those that are very wealthy have a lot of disposable income, right? And they can put a lot of that money away, so they maybe need to pay more. Cool. So for example, a flat tax person makes $40,000 a year. They pay, and let's say they had a 20% flat tax, they would pay 20% of that $40,000. Person who makes $200,000 would pay $40,000 in taxes. Okay, so both are charged 20% of their income, regardless of what it is. Now, here in America, the income tax is what's known as a progressive tax. So a progressive tax means that the tax is designed to take a larger percentage of income from the wealthy than from the poor. So the argument for this is that the wealthy can afford a higher tax because they have more disposable income. And the argument against is that why should the hardest working and more successful people pay more taxes? Before we get into these tax brackets, so we're going to talk about what the income tax looks like here in America and talk about what tax brackets mean. But before, let's talk about what income tax is in general. So for most people, you pay your taxes as you earn your money. So you get a paycheck and taxes have already been deducted. You've already paid tax as you earned it. So most companies have this set up where their employees pay their taxes as they earn their money. And then later on in the year, you file your taxes, which is where you confer with the government and decide, did you pay too much or pay too little? So this is called tax returns. You guys have probably experienced this sometime around April-ish. You file your taxes. Basically, this is where you get a report from your company that you work for. The company says how much you've paid throughout the year before, in taxes. And you've got to figure out, is that the right amount of tax, or did I pay too much, and does the government owe me some money back? And that's typically what happens with most people. Typically, most people get a refund for their taxes. So for most folks, they pay a little too much, and then after they take some credits or deductions and things like that, they end up getting some money back. It is possible that when you file your taxes, you find out you didn't pay quite enough and you have to pay more, which is unfortunate, but it happens. Cool. So this is what a W-2 looks like. This is what a company will give you at the beginning of a year, and it lists out how much you made, how much you paid in tax. So for example, this person made $48,500, $6,800 of that was held for taxes. So they would need to, when they file their taxes, figure out, is that the right amount? Did they pay too much? Are they owed some money back? Did they have to pay more? And so on. So for most people, when they do their tax return, they either rely on a CPA, that's a certified public accountant, and this is a person who does all the math for you and checks and makes sure you're getting all the deductions you need and things like that. There are also digital services. There's software that does this as well, right? Most people use something like TurboTax to file their taxes, which is sort of a stand-in for a CPA. It'll kind of walk you through the process, and for most people, this is good enough. It'll say, basically, TurboTax is very easy to use. It'll say something like, what's the number in box 1? What's the number in box 2? It'll kind of walk you through step by step how to file this and what to check for, ask you questions about certain credits and deductions that you may be owed. So basically, the federal government has set up a progressive tax, meaning that for the lowest earners, they're taxed much less than the highest earners. So if you make $9,875 or less, you pay 10% on your taxes. Okay? And then as you move up through these next brackets, you pay that percentage on that chunk of money. So what we have basically is a piecewise function. Let me get this graph open for you real quick. Cool, so it's going to look a little complex, but I'll walk you through it here. All right, so for the first $10,000 or so, you pay 10% on your taxes. Okay, so that's this chunk right here. And then we need a new function to describe what's happening after that. So you can see I've kind of defined when x is between 0 and this amount of money, we pay 10%, right? Just 0.1 times x. Now for this next chunk, so between 98.75 and 40,000, we're going to pay 12%. But you're not paying 12% on all of that money. You're only paying 12% on the chunk that comes after 98.75. Okay, so for example, if a person makes $20,000, they're going to pay 10% on the first about 10,000, and then 12% on the next about 10,000. Okay, so you can see that as we kind of move along this piecewise function, this broken chunks of function, our slope is going to increase a little bit. 10% on the first $10,000, 12% on the next chunk, then we move up to 22%, okay, and then we move up to 24%. So you can see that the line is just getting slightly steeper as we move into heavier brackets. But at no point is there kind of a jump, right? It is almost kind of pseudo-continuous here. Cool. So again, this is kind of a lot. We're not going to deal too much with the piecewise functions in this class, but I thought I'd represent this in a way that you're a little more familiar with using just a simple algebraic function. It gets a little complex when we have to restrict all these domains to make all these different chunks. But this is the general idea. Cool. So when I see something like, well, I make $500,000, so I pay 35% in tax, that's not actually true. You pay 35% on the amount of your salary that's over this much, but not on the whole thing. If we actually look at someone who makes $500,000, 500,000, we can see that they're paying just under 30% in taxes, not 35, right? Because they didn't pay that much on the first chunk of money. Hopefully this is making some sense. Cool. You may have heard that you can either file your taxes as a single person or as a married person. So there are some slight benefits to filing married, so I thought I'd show you those as well. It's basically just double the amount to get to the next bracket. Cool, there's the graph again. Cool, so that's not the end of the story when it comes to income taxes, and the reason it gets much more complicated, and the reason that people need CPAs or TurboTax to help them file, because we also have tax credits and tax deductions. So tax credits lower your taxes directly. So for example, if you own a home, you can earn a credit for that, right? You have to pay property taxes, right? But you get a credit for owning a home. You get a credit for getting your education. For example, I am currently in grad school right now, and when I filed my taxes this year, I got about $1,000 in a continuing learner credit, something like that. I forget what it's called, but basically there was $1,000 that I got back for continuing my education. So there's lots of stuff like that. If you have dependents, meaning you have children, basically, that you look after, right, you can get a credit for that as well. So these lower the amount of taxes you have to pay directly. Tax deductions are slightly different. They don't lower the amount of taxes you owe, but they lower the amount of income that's taxable. So for example, let's say I make $50,000, but 1,000 of that I spent on work expenses, right? Buying school supplies and things like that, right? That $1,000 would not be taxable income. And actually for teachers, there's a limit up to, I think, $250. So part of that, at least, I wouldn't get taxed on. So things that you can deduct if you buy stuff for work. So if you have to buy some steel-toe boots, right, for your job, then you can deduct that. You don't have to pay taxes on the income that you spend on that. If you have to buy a car for work and things like that, often you can deduct a little more than you expect. And again, this is a place where you can, I'm no expert, I'm not a tax person, I'm not a CPA. You would really need to talk to someone who knows to know exactly what you can deduct. But a lot of things, like if you move across the country for a job, that's a deduction, right? That can lower your taxable income. One that's kind of in the news right now, capital losses. So if you have investments that lose you money, let's say I have a bunch of money in the stock market and it's not doing so well, I've lost a bunch of money, then I can actually sort of count that against my income so that I'm not actually taxed as much. That appears to be what's happening in the news right now, although questionable how that's happening. Anyway. Cool, some other things that are kind of interesting. Social Security is separate from your income tax. So this is something that everyone pays. You'll see this when you get your paycheck. You'll see that you paid a certain amount to federal taxes, and you also paid to Social Security. So this is sort of a safety net that our government has set up, mostly for older Americans, disability insurance, and things like that. Medicare, and this is sort of a national health insurance service, especially for older people and people with disabilities. Unemployment taxes. So this is typically paid by companies, by employers, to provide unemployment compensation for people who get laid off. Okay, so if a company has to downsize, for example, because of the coronavirus, right, if they have to lay a couple people off, then that company is going to continue paying them at least for a little bit. Sometimes the government can step in and pay for that as well. Cool, so we said that in Oregon we don't have sales taxes, and that's not completely true. There are some sales taxes depending on what you're buying. So these are called luxury taxes, also known as sin taxes. So there are certain products that even in Oregon, where there's no general sales tax, you still have to pay taxes on. Things like cigarettes and alcohol and gas and marijuana. Basically, these taxes are levied to discourage use of the item. For example, in Oregon, we have a pretty heavy tax on gas, right, to discourage people from driving as much, to try to lower our carbon emissions, called a carbon tax, which is a form of a luxury tax. Some other interesting tax stuff, and again, I'm no expert, but these are just some broad view stuff of what's happening. There's something known as a gift tax, so you're not allowed to give people lots and lots of money or property without it being taxed, and I think this is sort of to close up a bunch of loopholes. I think people make a lot of money and then they give it away to their daughter or significant other or something like that. Yeah, so there's actually a limit on how much you can give someone without it having to be taxed. Import taxes, these are known as tariffs. So basically, if a government wants to raise the price of foreign goods to help American companies, that can happen. That's happening a lot. We have sort of a trade war going on with China, where a lot of Chinese goods coming in are tariffed, meaning you have to pay a little bit extra in tax on those things. There's also something known as the estate tax, which is controversial. This is a tax on the total amount of money and property a person has when they die. So if someone dies and they're worth over 1.5 million, these numbers may have changed a little. Basically, the government can take part of that. It's called the death tax or the estate tax. Yeah, another controversial one. Cool. I don't want to talk much about surplus and deficits. Basically, the government tries to collect the same in revenue as it spends, but this has not really been happening. The government is spending a lot more than it's making in tax revenue. This is a little over my head, but that's the basic idea. Cool, so those are all about the federal taxes for the most part. There are also state taxes, right? The state of Oregon can tax you. The government, or the federal government, so the U.S. can tax you. The state of Oregon can tax you. The city of Portland can tax you. Right, so there are different levels of taxes. So state taxes, a state can decide whether or not they want to do a sales tax. Here in Oregon, there's no sales tax. Up in Washington, there is a sales tax. The state can also choose whether or not they want to do an income tax. So in Oregon, when you get your paycheck, you pay a federal income tax and a state income tax. If you worked in Washington, you would not pay the state income tax. Cool. There's also local taxes. So something like a property tax is maintained by the local government. So if you buy a house in Portland, you need to pay a tax on that property to the local government. Property tax or local taxes are usually sort of have a direct impact on the local community. A lot of our school funding comes from local taxes. Law enforcement, public transportation, like the MAX and stuff like that, usually mostly paid for by local taxes. Cool. All right, so that's just about everything you need to know. Those are the broad strokes. Again, this is not super duper intensive, right? We can go into lots and lots of details. There are whole careers built around understanding tax code and being able to not only understand the laws behind taxes, but to maximize individuals' tax returns and things like that. So again, this isn't exhaustive, but these are the broad strokes. These are the things you need to know in order to figure out your own tax situation. I hope you learned something. Again, don't forget to answer the question at the end to submit your assignment for the day. Thanks, y'all.